Hi, this is Will Cook with the Will Cook Group. Welcome back to my video blog. Today, I'd like to touch on what the Federal Reserve's continued rate pause means for home buyers and home sellers, and specifically talk about how the Federal Reserve affects the housing market, mortgage rates, and what will happen to housing if mortgage rates rise. The Federal Reserve is keeping its finger on the pause button. The central bank raised rates 11 times in 2022 and 23 with the expectation it would be reversing course this year. But as inflation trended up, the central bank is standing pat. Following the Fed's May 1st meeting, which was its third gathering of the year, Chairman Jerome Powell held steady again, announcing no change in interest rates for the time being. How does the Federal Reserve affect the housing market? Well, to give you some history, earlier in the inflationary cycle, the Federal Reserve had enacted multiple rate increases. Now that inflation is down to about 3.5%, still higher than its official 2% target rate, that round of tightening appears to be over. However, until inflation drops to that 2% target, housing economists are wondering when the anticipated rate cuts will begin. In an effort to rein in inflation, the Fed boosted interest rates aggressively in 2022 and 2023. The hikes aimed to cool an economy that was on fire after rebounding from the coronavirus recession of 2020. That dramatic recovery included, as you may recall, a red-hot housing market that characterized by record high home prices and microscopic levels of inventory. Well, now the federal rate hikes have slowed the housing market and the rate of home sales have dropped off sharply. How exactly does the Federal Reserve affect mortgage rates? Well, the Federal Reserve does not set mortgage rates. And the central bank's decisions don't move mortgages as directly as they do other products like savings accounts or CDs. Instead, mortgage rates tend to move in lockstep with the 10-year Treasury yield. Still, the Fed's policies set an overall tone for the mortgage rates. Lenders and investors closely watch the central bank, and the mortgage market's attempts to interpret the Fed's actions affect how much you pay for your home loan. The Fed bumped rates 7 times in 2022, and that year saw mortgage rates jump from 3.1% in January to over 7% in October. And in 2023, mortgage rates went higher still, briefly touching 8%. What will happen to the housing market if interest rates rise? Well, there's no doubt that the record low mortgage rates helped to fuel the housing boom of 2020 and 2021. Some think it was the single most important factor in pushing the residential real estate into overdrive. But then, when mortgage rates surged higher than they had been in 2 decades, the housing market slowed dramatically. And while sales have remained slow, housing prices have remained high. In the long term, according to economists, home prices and home sales tend to be resilient to rising mortgage rates. That's because individual life events that prompt a home purchase, the birth of a child, marriage, a job change, retirement, don't always correspond conveniently with the mortgage rate cycles. So the current slowdown may be more of an overheated market's return to normalcy rather than the signal of a housing crash. But if the mortgage rates pull back, affordability will become less of a factor, and a continued decline in mortgage rates could create a new challenge: competition. It will likely draw new buyers into the market, which is a surge that could further intensify the ongoing shortage of homes for sale. If you're in the market to buy or sell a home in the greater Palm Springs area and you have questions about your unique situation, I'd love to have a conversation with you. Please feel free to reach out to me with a phone call a text, or an email. Also, if you have any other real estate related topics or questions that I can answer, I'd be happy to address those as well. Thank you so much for watching. See you next time.